Hey, soldiers, the Fed thinks inflation is still running hotter than they want it to. Therefore, the risk of additional rate hikes is pretty high. Now, some believe that if we continue to hike rates, that's going to push us into a recession, and it's going to be a 2008 style recession led by the housing market. I disagree. I do believe that, consistent with history, increases in rates have led to recessions, true, and I think the chances of a recession are high. But I'm going to tell you what I think is going to lead us into that recession this time. History doesn't so much repeat as it rhymes. So we're not going to see it led by housing. The housing market is going to fare a little better than I think most people, are supposing at this point. And I'm also going to tell you what you need to do right now, because if the Fed does raise interest rates, you want to have yourself in a good position. So I'm going to talk to you about something that you might want to consider, and you'll come out on top whether they raise rates, keep them where they are, or lower them. So according to the Fed, in fact, most Federal Reserve officials last month still regarded high inflation as an ongoing threat that could require further interest rate increases. This is according to the minutes from the most recent Fed meeting that occurred on July 25th and 26th. At the same time, the officials saw, quote, a number of tentative signs that the inflation pressures could be abating. Now, I posted I was in the grocery store, and if you go on the community page, you'll see I posted a picture from Safeway. That's a grocery chain here in Maryland. They had 30 ounces of Miracle Whip going for $8 and change, and that was with the bonus card. Without, as you'll see in that picture, it was well over that. So we got, and I know there are two warring factions in America, those that love Miracle Whip and those that hate it. I'm in the former camp. But anyway, it's just one example of how inflation is affecting our everyday lives. And don't forget, people, inflation, we're not going to see prices reverse. Sure, we may see a slowdown in the rate of increase, but we're never going to see those prices revert. So if you like Miracle Whip, just keep that in mind. Now, we also have to understand that when the Fed talks about 2% inflation, that's their target. Remember, if we base it on the way inflation was calculated prior to all the smoke and mirrors, sleight of hand, in order to try and make politicians look good, real inflation is well above what the stated number is. We always take a look at John Williams' shadow stats in order to look at what inflation's really doing, and as you can see, it's well above what the stated 4 or 5% is right now. So that 2%, that's something that they'll use, but remember, it's still going to be well above that, and that makes it imperative that when you're looking at rates of return on your investments, you've got to get well above what they state as inflation. Otherwise, you're really going to be either treading water or drowning, all right? At the same time, okay, so they saw some tentative signs that inflation could be slowing down. They certainly weren't in Safeway walking through that condiments aisle with me, because they wouldn't have got that impression. According to the minutes, the Fed's policymakers also felt that despite signs of progress on inflation, it remained well above their 2% target. They, quote, would need to see more data to be confident that inflation pressures were abating and on track to return to their target. So remember, the Fed always expects, there's never been a time in modern economic history here in this country where we didn't have some inflation. Over the course of the past few years since 2020, for reasons that we've been over several times, and you know very well, we've seen an increase in inflation because politicians decided to do all manner of things that were contrary to the economy, like disrupt the supply chains. They shut down the economy, and that we're still dealing with that. You cannot slam the brakes onto a Ferrari like our economy traveling at 180 miles per hour. You can't slam the brakes on and expect that, you're going to come to a complete stop and then everything's going to be okay with the vehicle after that. At the meeting, the Fed decided to raise its benchmark rate for the 11th time in 17 months in its ongoing drive to curb inflation. But in a statement after the meeting, it provided little guidance when or whether it might raise rates again. Most investors and economists have said they believe July's rate hike will be the last of the year. I suppose that's the conjecture. They won't be the last, okay? Earlier this week, economists at Goldman Sachs projected that the Fed will actually start to cut rates by the middle of next year, a distinct possibility. Now, as I said to you in the open, some people are afraid that, or very apprehensive about the possibility that this might lead to another 2008 style recession and put a lot of pressure on the housing market. Americans, this is from Zero Hedge, they're saying Americans are not prepared for tougher times, and that is very true. We're going to go over some data in a moment that shows you just that. One recent survey, this is outside of the deeper data we'll look at in a moment, discovered that 72% of Americans are not financially secure and 61% of adults are living paycheck to paycheck. We did a video about that. Many of those people could lose their jobs in a recession, that's for sure. And that will make it harder to pay the car note, the credit card, and the mortgage. Three of those important bills that have a downstream effect on the overall economy if you can't pay, right? It's not like your gas and electric bill where you're going to get that back on, or you're going to work something out with the company, especially as the Northern Hemisphere goes into winter. I know in Baltimore City, there used to be this thing where our gas and electric company would not shut you off in the winter. But, first 70-degree day, you were on your own. Delinquency rates. Now, this is why I'm starting to believe that this is not like 2008. Because while foreclosure rates are up, you remember we did do the video on rising foreclosure rates, rising repossessions of vehicles, and, of course, the over $1 trillion in credit card debt that Americans have collectively. However, the delinquency rates for mortgages, so people paying their mortgages, they're actually at an all-time low. Now, how can this be if the economy is under such pressure? But remember, one of the problems back in the run-up to 2008 was the fact that a lot of people got caught with the variable interest rate loan on their mortgages. Okay, that was one of the issues. A lot of people got caught out there, didn't understand the product, and as rates rose, their mortgages became unaffordable, or the no interest loan, or there were several different crazy products out there. Not no interest. You're probably never going to find a no interest loan for 30 years, right? But the no income, no job, they called it ninja loans. So there were all kinds of crazy products out there. You had the subprime debacle that blew up in the faces of Lehman Brothers and all of these other banks and led to the bailouts and that whole era of fallout. You don't have those exotic products out there to that degree. So that's why you're seeing folk able to maintain their mortgage, because they're not these, fluctuating rates that are catching people off guard. A lot of these loans are just straight up, 15 or 30 year fixed rate mortgages. So you have that. Now, what do I think will lead us into a recession? Well, look, guys, we've chronicled, and I mentioned it just a moment ago, with regard to the $1 trillion in credit card debt. That's one thing. And Americans are running out of money. Now, we're going to get to how you can, look out and say, look, I need to fix a few things or consider a few things. Americans are definitely running out of money. Discomfort with savings is high. This is from Bankrate. They did surveys. 57% of U.S. adults are uncomfortable with the amount of emergency savings they currently have. Fewer have no emergency savings. 22% of U.S. adults have no emergency savings at all. The second lowest percentage in 13 years of polling. So on the one hand, it's not higher, great, but that 22%, they're hanging out there in the wind, right? Growing debt is hurting savings. That's right. As these interest rates go up and your exposure to variable rate credit cards, for example, it's going to take a toll on you. As of January polling, 36% have more credit card debt than emergency savings. And look, it's August. I think that will definitely hold true. Emergency savings do need a boost. We highly recommend that. So if you're getting to the point where you're like, look, my job may face layoffs, if you're in that type of industry, like folk that work in social media. I know a lot of people that work in social media for Meta and, Google, and they may be exposed to this because if companies stop advertising or slow down on advertising, then of course these companies like Meta and Google will see a decline in revenue. And that might extend to having to lay folk off. As we always say, tackle that high interest debt. Look for that zero rate transfer to get that high interest balance over to zero rate and buy you some time. Because you got to get away from being exposed to this. Imagine if you're able to transfer that to a zero balance card or even a card with a lower interest rate for a period of time. You need to calculate how much money you will be saving. That way, you'll be able to take some of that money and defray what's happening out there. Pump up that emergency account, right? Just in case the unfortunate happens and there is a layoff, you can ride it out further without having to, resort to credit card debt, which, if you're nearing your limit, is going to, be a short-term fix anyway. And look, guys, I want to mention briefly, if you do have $10,000 or more in debt, visit mcenow.com/get debt free. We have partnered with Debt America, professional debt resolution specialists that we can put you with that will help you get that debt tackled, build a plan to get that debt knocked out, get you back on the road to financial independence and away from the slavery of debt. Okay, guys. So listen, what I want you to do now is I want you to go and watch this video right here. The banking collapse. All right. Now, Fitch is looking at doing something with the banking industry as a whole, which will have ramifications for more than likely whoever it is you bank with. You need to watch that video. Guys, I'll talk to you soon.